The most powerful central bank on earth just made a move that could decide whether the world economy glides to safety or spirals into another crisis. Imagine waking up tomorrow to find your mortgage cheaper, your stock portfolio soaring, and your national currency under pressure, all because of a single decision in Washington. That is exactly what happened when the U.S. Federal Reserve cut interest rates for the first time this year. The cut was small, just 0.25 percentage point, but the signal it sends is enormous. It tells us that America's economy is slowing, jobs are at risk, and the guardians of global finance are scrambling to steady the ship. The question is simple but urgent. Did the Fed just save the day, or set the stage for something far worse? For months, speculation has swirled. Would the Fed hold firm, keeping rates high to finish the fight against inflation, or would it finally blink, worried that the job market was cracking? The answer came on September 17, 2025. Chair Jerome Powell announced that the federal funds rate would be lowered to a range of 4.0 to 4.25%. He admitted the labor market was softening. Job growth, once the engine of post-pandemic recovery, had slowed to stall speed. Unemployment was creeping higher, particularly among young people and minority groups. Powell told reporters, "We don't need the job market to soften anymore." Those words marked a pivot from fighting inflation at all costs to defending jobs at almost any cost. It was a dramatic shift for a central bank that had spent the last 2 years raising rates aggressively. Starting in 2022, the Fed lifted borrowing costs to the highest levels in more than a decade, determined to crush the worst inflation since the 1980s. The strategy worked. Annual price growth cooled from over 9% to under 3%, but the pain was real. Mortgage rates soared above 7%. Car loans became unaffordable for many families. Small businesses struggled to finance growth. By mid-2025, the cracks were showing. Payroll gains slowed, layoffs ticked up, and economists began whispering the word recession. The Fed had to choose: keep pressing on inflation or ease up to protect jobs. The decision was not unanimous. One newly appointed governor, Stephen Moran, argued for a larger cut of 0.5 percentage point. President Donald Trump had openly demanded the same, accusing the Federal Reserve of moving too cautiously. Powell resisted, settling on a smaller adjustment, but leaving the door open for more cuts. "There are no risk-free paths," he said. "We must keep our eye on inflation, but we cannot ignore employment." That balancing act defines central banking, the tension between growth and stability, jobs and prices, politics and policy. Markets reacted instantly. Stocks surged on Wall Street as investors celebrated lower borrowing costs. The bond market priced in expectations of at least 2 more cuts by year's end. The dollar slipped against major currencies, a welcome relief for emerging economies weighed down by dollar-denominated debt. Commodity prices shifted, gold strengthened, oil ticked upward. Every corner of global finance responded to the Fed's move, proving once again that its decisions reverberate far beyond America's borders. Winners and losers are already emerging. Borrowers win. Homeowners refinancing mortgages, businesses rolling over debt, consumers carrying credit card balances, all will see relief. Corporate America, especially capital-intensive industries like construction, manufacturing, and energy, gains breathing room. Politicians, too, enjoy a short-term boost. Higher stock markets make for good headlines, but savers lose. Retirees depending on interest income will see their returns shrink. Banks may see narrower profit margins, and inflation hawks worry that easier money will reignite the very price pressures the Fed spent 2 years fighting. In economics, every choice creates trade-offs, and this one is no different. Globally, the consequences are even more profound. In Europe, central bankers at the European Central Bank must decide whether to follow suit. If the Fed cuts while Europe holds steady, the euro strengthens, making European exports less competitive. In Asia, countries like Japan, South Korea, and Singapore are recalibrating their own strategies. In emerging markets from Brazil to India, a softer dollar eases pressure on currencies and debt repayments. For commodity exporters, a weaker dollar can mean higher revenues, since oil, copper, and other goods are priced in dollars. In short, a small cut in Washington reshapes calculations everywhere from Brussels to Beijing. History offers both encouragement and warning. In 2008, aggressive rate cuts helped prevent a total financial collapse. In the early 1980s, the Fed's determination to crush inflation restored credibility after years of turmoil. But in the 1970s, cutting rates too soon led to stagflation, that toxic mix of high prices and stagnant growth. Powell knows these lessons. His cautious tone reflects a desire to avoid both runaway inflation and a deep recession. But the risk remains. If the Fed cut too early, inflation could flare again. If it cut too late, the economy could already be sliding toward contraction. There is also the question of politics. The Federal Reserve prides itself on independence, but presidents often apply pressure. Donald Trump has long demanded lower rates, arguing they are needed to boost growth and strengthen America's hand in trade wars. Powell denies bending to politics, but markets notice the overlap between Trump's demands and the Fed's actions. Credibility is the lifeblood of central banking. If investors suspect the Fed acts for political rather than economic reasons, trust erodes and volatility rises. What comes next? 3 scenarios loom. In the best case, this is a soft landing. The rate cut stabilizes the labor market, supports consumer spending, and prevents layoffs while inflation remains tame. In the middle case, the Fed must cut further, perhaps 2 or 3 times, to fight off a shallow recession. Growth weakens. Unemployment rises modestly, but the system holds. In the worst case, the Fed miscalculated. Inflation returns, markets lose confidence, the dollar weakens sharply, and capital flees to safer assets. In that world, the Fed might face the nightmare of raising rates again into a weakening economy. A lose-lose situation for everyone. And so, the world waits. For American workers, the question is personal. Will this decision protect your job or threaten your savings? For global investors, the question is strategic. Will this cut fuel growth or spark instability? For history, the question is monumental. Did the Federal Reserve just steer the ship away from danger or plant the seeds of the next storm? In the end, one small quarter-point move may decide the fate of the global economy.